Hello, my name is Riley Arnold. I am a senior in the Applied Investment Management program at Marquette University covering information technology both domestically and internationally. And today I will be pitching SPS Commerce Incorporated, ticker SPSC. To give you a little more insight into what kind of company SPS Commerce is, they are a full-service global cloud-based supply chain management provider that engages in sales of their platform and services to customers through contractual agreements. They typically approach small to mid-size retail industry participants, ranging from retailers to sourcing companies to third-party logistics, among others. The company typically generates revenue through two primary streams, recurring revenues and one-time revenues. The recurring revenues segment can then be further broken down into the two operating segments, which SPS Commerce uses in their daily operations. Fulfillment, which served as 78% of fiscal 19 revenues, and analytics, which was 12%. The company was founded in 1987 and is headquartered in Minneapolis, Minnesota. When looking for a company this time around, I wanted to choose a reputable company that was disrupting current market trends and had a strong financial historical performance that I believe could help support our portfolio during the uncertainties of COVID-19. When it came to software technology, I wanted to find a firm that was ahead of the curve and was employing cutting-edge technology throughout their operations. I decided to pursue SPS Commerce and Global Supply Chain Management, or SCM, because of the growth the market has seen and will continue to see for many years. The global supply chain management market is projected to grow from almost 16 billion in 2019 to more than 37 billion by 2037, a CAGR of 11.2%. At the same time, new constraints brought about by COVID have reinvigorated interest in the concept of global supply chain management, as monthly searches of the topic have increased more than 30% following the outbreak of the pandemic, according to Google Trends. Weaknesses such as lack of flexibility and limited communication across supply chains have caused many companies to look for ways to both cut costs while optimizing their in-house supply chain structure and moving away from traditional point-to-point integration structures that have their weaknesses exposed due to COVID. I believe that SPS Commerce is well positioned to address this reinvigorated interest in global supply chain, and I see this large market opportunity as a consistent contribution to SPS's bottom line growth in the coming years. In addition to a large growing market, another great thing about SPS is their unparalleled network of connections. With software partners like Microsoft and Amazon and retail partners like Walmart and Costco readily available in their network, SPS gives the new customers the opportunity to expand their business and utilize new connections to meet their needs. These partnerships, combined with the large suite of capabilities provided by SPS, provide an invaluable networking opportunity that would otherwise be too costly and thus not a core competency for many of these smaller to middle market retail players. I believe that because of this low-cost, customer-centric model, SPS has differentiated themselves from traditional supply chain management players and utilizes their large network to do so even further. While this is something that may not seem like a third driver, I would argue that it is a solid driver to look for, especially given the nature of SPS Commerce as a technology company. With 78 quarters of revenue growth, consecutively, SPS Commerce has not wavered in their growth targets, enjoying a healthy gross margin above 60% since 2011 and a 15% net margin expansion since fiscal 2015. The firm's track record has been almost historically perfect. On top of this historical prowess, SPS has managed to beat all street expectations through the current COVID situation, beating all second quarter estimates by more than 5% and reinstating management's annual guidance targets from pre-coronavirus. I firmly believe that with management gaining greater visibility as to SPS's exposure to COVID-19 and the heavy retail season still on the horizon, SPS is expertly positioned to weave through both rising consumer demands and further restricting COVID effects. With a large market growth opportunity over the next several years, a robust, unbeatable customer pipeline, and historical trends that are only further bolstered by re-accelerated interest brought about by COVID-19, I believe that SPS Commerce is a great fit for the small cap portfolio, and I recommend that it be added with a price target of $83.69, representing a 13.7% upside. My first driver is a virtually untapped market. As I mentioned previously, the global supply chain management market is expected to grow at an average CAGR of 11.2% through 2027, amounting to more than $37 billion in that time. Before I explain how this is a great opportunity, I want to explain the three types of global supply chain management providers that are typical within the present industry. The largest base of players is the traditional on-premise software providers that feature point-to-point integration structures. While these have traditionally been the most dominant players, many of these are shifting to cloud-based on-premise services, which is the second type of provider and has become more popular in recent years. The third and final type of market player is a full-service cloud-based provider, which does not require any on-site platform or maintenance and is managed through off-site data centers. This category is relatively new, and although traditional players have cloud services, there are few, if any, that go to the extent of full-service cloud-based providers, and they do not manage off-site. SPS Commerce further differentiates itself this way by being by far and away the largest full-service cloud-based provider in the market at the current moment. Despite this, management has estimated that SPS has only penetrated about 5% of their market, with their top 100 customers holding less than 1% of their revenues. This large share of market to yet be penetrated is valued at more than $5 billion by management over the next several years. Conservatively speaking, with such a large opportunity, SPS could see an increase in average annual revenues anywhere from 2 to 6% per year, depending on the amount of new customers acquired, new contracts signed, and additional products introduced to the customer portfolio. My second driver deals with SPS's customer network and their viability of connections. Currently, SPS serves more than 90,000 customers across 70 countries. These 90,000 customers include several players in the retail industry, as well as software partners, channel partners, and others. This large base helps serve as an omni-channel customer pipeline that SPS can use to acquire more customers. When SPS first signs a contract with a new customer and implements their software and platform, customers will immediately be given access to SPS's large network and full suite of services. The customers can then rapidly expand their business using this technology and newfound connections from SPS's partners. Oftentimes, while these new customers are expanding their business, they require additional implementations of SPS software in other parts of their supply chain. For example, a customer supplier that is not already affiliated with SPS or a manufacturer in which a supplier may need to get connected. These additional implementations count as new customers and new sources of revenues for SPS. Thus, as the company continues to introduce more products to their portfolio and bring in new customers, their pipeline only becomes larger. This is further enforced by their recurring customer base in years past. As of fiscal 19, SPS's recurring revenue customer base topped 31,500 monthly customers. Additionally, wallet share, or average revenue per customer, breached 9,000 in the same period. Management's goal in the mid to long term is to increase this base to more than 200,000 recurring revenue customers and increase wallet share to more than 25,000 per recurring revenue customer. If management is successful at continuing to grow business and sign new customers, SPS can see an additional 2.5% top line growth per year. My third driver deals with SPS as a predictable performer. As I previously mentioned, the company had enjoyed 78 consecutive quarters of revenue growth while also maintaining margins above 60% since 2011 and EBITDA margins expanding 15% since 2015. While this expansion seems to have slowed down or have been priced into the stock, I would say just the opposite. With SPS's strong customer pipeline and expanding base, the firm's costs will either maintain or decrease over time. This is because with the unique single point connection model through SPS, they are connected to all their clients in real time and can update their software and services instantaneously. Since SPS does not require large upfront investments from customers to install their platform, SPS can take operations costs and dilute it across their customer base. Thus, as their base continues to strengthen, SPS will see these margins and growth rates continue to expand. In fact, SPS management has outlined goals to break 70% gross margin in the next 5 years and surpass 30% EBITDA margin at the same time. While these estimated trends are strong, I believe that the resilience shown by SPS through COVID will help reap even greater benefits for the company in the near term. Already, the company far outperformed expectations for second quarter of this year, adding 5% additional new customers and beating all street revenue expectations by at least 200 basis points. As a result, the stock has been performing excellently, beating the benchmark Russell 2000 by a 42.58% margin year to date. As the heavy retail season is still to begin and more companies continue to seek options for cost cutting and optimization, I believe SPS is poised to grow even further in the next 6 to 12 months, bringing in additional 2% of customers per quarter. Moving on to my valuation, the first valuation that I conducted was a 10-year DCF. For a couple of my inputs, I used weighted average cost of capital of 7.56% and a terminal growth rate of 2%. I used 2% in my terminal growth rate because I believe that despite the current macroeconomy situation, I believe that SPS is poised to grow beyond that and will continue to do so for several years. By using these inputs, I got a DCF intrinsic value of $86.98. When I performed a sensitivity analysis during this valuation of plus or minus 50 basis points on the WACC and terminal growth rate, it resulted in a range of $74.20 to $86.89. My relative valuations consisted of a PDE multiple valuation and an EV to EBITDA multiple valuation. For my PDE, I used a last 12 months 2019 EPS of $1.11 and a PDE multiple of 73.34, resulting in an intrinsic value of $81.53. For my EV to EBITDA valuation, I used a multiple of 44.14, resulting in an intrinsic value of $75.96. By weighing these three models 60, 20, 20, I came up with a price target of $83.69, representing a potential 13.7% upside. Despite the strong trends supporting SPS right now, there are a couple risks that I must cover because at the end of the day, no company is perfect. The first and most important risk is the uncertainty dealing with COVID-19. While I do believe that SPS is resilient enough to overcome any challenge put forth by the pandemic, if the pandemic wreaks havoc on the retail industry again, like it did the first time, there is no telling how the retail market or the entire economy will react again. As such, with so many unknowns, if it does not go the way that SPS was expecting, revenues could be adversely affected. Moving on, my second, albeit less important risk, is short-term contracts. Currently, all of the contracts that SPS has with their customers are 30 to 90 days in length and are typically renewed on a monthly basis. If COVID continues to change expectations or SPS fails to meet their current consumer expectations, the revenues could be adversely affected. While I don't see this as a problem that is ever going to happen to SPS, it is something that I feel is a necessary risk to include given that the environment is so uncertain. Really quickly, I wanted to touch on SPS's management as I believe they have been integral to the success of SPS over the past 10 to 12 years. RGC Black currently serves as the president, CEO, and executive director of SPS and has been with the company since 2001. He received his undergraduate degree from Marquette University in 1984. Jim Frome is the current Chief Operating Officer at SPSC and also the Executive Vice President of the Board of Directors. He has been with the company since 2000. Kim Nelson is SPS's Chief Financial Officer and also an Executive Vice President of the Board and has been with SPS Commerce since 2007. At this point in my presentation, I would like to thank you for watching the rest of it. And if you have any questions to ask me about SPS Commerce, you can do so under the D2L discussions page, or you can tune in directly to the live Q&A sessions on 11 a.m. on Friday, September 11th, and ask me questions there. Thank you.